The crisis in the financial advice industry gets worse, with planners fleeing the industry and investors turning to social media. Prime Minister Scott Morrison takes a swipe at anyone wanting to vote for an independent, and traffic flows are finally getting back to normal. It's Tuesday, the 19th of April, 2022. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, I've got a fantastic review I want to share with you. I reckon this could be the best review we have ever received on Fear and Greed. So just a little bit of navel gazing for a second. This is left for us on Apple Podcasts. And I thought we'll start the show on a bit of a kind of a feel-good note. This is from Tony, who has written, "Never miss one, never miss an episode of Fear and Greed. A huge thank you to the team for your continued work in creating a fantastic podcast. We religiously listen to the shows as part of our daily routine and greatly appreciate the clear and concise market updates. In addition, we love the insights gained from your various guest interviews. Keep up the great work." Isn't that fantastic?
Don't you love a review like that? Thank you very much, Tony.
That is just great. And look, that's on Apple Podcasts, and we have hundreds of 5-star ratings on Apple Podcasts and a stack more on Spotify. So please, if you're enjoying Fear and Greed, leave us a review, leave us a 5-star rating. It is greatly appreciated, especially when it's as good as Tony's.
Yeah, absolutely. And I'd just have a quick shout out to Doug. Dougie, I met Dougie on the weekend for the first time. I was at some sporting event and I was chatting. I know Dougie's fiancée and his fiancée's parents, and he turned around and said, "You're the Fear and Greed bloke." He's a McGrath nickel man, Dougie, and he was very complimentary of the podcast. And so I said, "Dougie, I'm going to give you a shout out on Tuesday morning." So there you go. Good on you, Dougie. Nice to meet you.
I'm curious to know whether he recognised you from your voice or from the half skull face of the artwork, because if it's the latter, then that's a worry, Sean.
I think he might have been worded up, to be honest.
Fantastic. And look, just on Tony's review, when he mentioned the insights gained from our various guest interviews, we have a fantastic interview coming up today with Amanda Rose, who's the founder of Small Businesswomen Australia. A really interesting chat, this one.
Yeah, sure is. Amanda is a force of nature. I've sort of known her for a long time. Really passionate about whatever she does. And, in this instance, we're talking about women in small businesses and just what a better economy we can have if we give women in small businesses a bit of a better go.
Yeah, it's a great chat. That's coming up a bit later on. But, Sean, we've got to get into it. The lead story today is quite extraordinary because the trend that I mentioned in the opener there is probably a little bit alarming. More than 100,000 Australians have stopped using financial advisors over the past year, and only around 10% of people get professional advice. This is according to a new landmark report. I find that just staggering.
It is staggering. The Advisor Ratings 2022 Financial Advice Landscape Report shows just what a mess the financial advice industry is in. Now, some of that's the fault of the government and some of it is the fault of the industry itself. First, to the facts and figures. The median cost of financial advice services last year rose by $270 to $3,529. That's 40% more than 3 years ago, and this is all according to a report in the Financial Review. Now, the number of Australians seeking advice fell 100,000, as you mentioned, to less than 2 million people, and many consumers are now relying on unlicensed social media influencers, according to the study. The number of advisors in the industry dropped by about 4,000 last year, or the equivalent of 16% of the industry. The highest fee paid, detected by the research house, was $12,000 for advice, and the lowest was about $800.
Sean, what is behind this? Is it that people don't want financial advice, or do they not see the benefits of getting financial advice, or is it just too expensive?
It's probably some of all of those three. Almost 1 in 3 Australians indicate they want financial advice, which is much higher than the number actually paying for it. But it also means 2 in 3 don't see the need for it. Now, my gut feel, Michael, is that given interest rates are about to rise and inflation is picking up fast, that ratio should really be the other way around. Add in the fact that many people will retire over the next decade with more cash than their predecessors ever had, and the need for advice becomes really, really evident. The upfront fee structure introduced over the past decade or so has deterred many, many people, notwithstanding an upfront fee might actually be cheaper than a trailing commission, but parting with $3,500 is just too rich for many investors. Also, new rules forcing advisors to hold tertiary qualifications. That's added to the reasons for professionals in the industry to quit. So people who have been doing this for 30 and 40 years suddenly have to go and get tertiary qualifications, a bit rough. And the fact that the big four banks have left the industry has left a gaping hole that really does need filling.
Sean, what about finfluencers? This is the advice provided on social media platforms.
Well, ASIC reckons about 5% of Australians receive all of their financial advice from social media, which, Michael, is just frightening.
Yep.
Yeah. The corporate watchdog is actually cracking down on that sort of activity, and so it should. There's also a few podcasts around, Michael, who throw just a little too much advice in. Now, it's why we always tell people to seek professional help and visit a financial advisor because they're the experts. Both sides of politics have promised to do something about the sector once the election is held and completed. Hopefully, they'll stick to that because something needs to be done.
Yeah, you're certainly right there. Now, Sean, the local market was closed yesterday.
They were. Markets globally are just a touch skittish at the moment on the back of higher energy costs and inflation, and then fears about China's economic outlook. A little more of that later on in the show. The good thing for the local market, and one of the reasons it's outperformed most other bourses this year, is that commodities remain high in demand and in price. And the local ASX is, of course, very commodity heavy.
Okay. We'll be back in a moment with the rest of the day's business news. Sean, we're into week 2 of the election campaign, and Prime Minister Scott Morrison is pushing hard the idea that a vote for the coalition is a vote for less uncertainty.
Yeah, it's sort of a funny way of putting it, really, because it's not so much come with us because I suppose it is come with us because you know what you'll get. But he has really been pushing the line, and particularly yesterday when he was talking about voting for high-profile independents contesting the election, he said they'll be a threat to stability and could throw Parliament into chaos and uncertainty. It's more about let's vote for less uncertainty rather than saying vote for us and it's greater certainty. It's kind of a very negative campaign. Now, his comments yesterday about the independents followed Sunday's discussion where on Sunday he finalised his front bench with Senator Anne Rushton replacing the retiring Greg Hunt in health, assuming they're re-elected. He emphasised again the benefits of knowing what you get if you vote Liberal National Party. Yesterday, Scott Morrison also criticised opposition leader Anthony Albanese for his approach to border protection policies. There is plenty of confusion about exactly what Anthony Albanese stands for in that area. Broadly, he's not very different to what Scott Morrison stands for, but certainly the coalition government is muddying the waters around that one. Mr Albanese had another tough day yesterday. New polling from Nine Media showed that his personal popularity as Prime Minister has slumped sharply. Then he got somewhat stumped on details of the opposition's health policy. He did say any government he leads will approve new coal mines. That's either good or bad, depending on where you stand on coal. And Mr Albanese also managed to get booed at the Blues Fest in Byron Bay when he introduced Jimmy Barnes. There you go.
There you go. And Sean, I'll just say probably one of the best things that I have seen personally, and obviously this is something that I have a bit of a vested interest in it. Both sides of politics have made a very big commitment in the health space over the last couple of days, funding essentially technology to assist with type 1 diabetes, kind of post the age of 21. This was an announcement that was made on the weekend by the government. Should they be re-elected, they would fund this essentially life-saving technology for type 1 diabetes sufferers post the age of 21. And this can save people's lives. It can essentially stop people kind of dying in their sleep effectively. And Labor has then gone and matched that commitment. And so this is basically, it is a fantastic outcome for this kind of sector of the community of sufferers, and it's predominantly young people where it kind of kicks in. So look, just wanted to give a quick little shout out to both sides to say, well done, this is a great policy, but please stick to it post-election.
Fantastic. I'm with you on that one, Michael.
All right, now moving on. The boss of toll road operator Transurban, Scott Charlton, says more people are driving to the office in the living with COVID world.
Yes, I thought this was quite interesting. People have more flexible hours as companies shift to hybrid models of work, and people want to steer clear of public transport. And so Charlton said there's been a marked increase in the number of cars on toll roads, particularly Melbourne's CityLink, which generated its highest traffic numbers last month since the beginning of the pandemic. Truck movements are higher and toll roads that feed into airports are much, much busier. Of course, that's all good news for Transurban. But I do think that it is quite fascinating that one of the probably unintended consequences of COVID is that we may end up with more traffic congestions because people will start driving into the office and, of course, don't want to use public transport.
Now, Sean, oil giant Woodside has applied to list on the New York Stock Exchange following its application to list in London. What's the reason behind dual or even more than dual listings?
Well, mostly it's access to capital. There's big pools of money in New York and London and European and Asian markets. And when you're an oil and gas company, finding as much support as possible over the next decade will be very, very important, particularly when it comes to raising money. Woodside's merging with BHP's petroleum business and eventually will be worth around $63 billion, assuming the May 19 vote gets the 75% approval rate. It's likely to do that. Now, when announced, the new group was going to be worth $43 million, but soaring energy prices has pushed up its value. Mostly, though, Woodside need to be able to get access to pools of money all around the world, hence listing, or secondary listings at least, on the New York Stock Exchange and the FTSE in London.
Sean, Bank of Queensland released its results late last week.
The regional bank's been on an expansion strategy last year, buying ME Bank off a group of super funds, and the results showed that really it just isn't making a good enough return on its investment. Net profit for the bank fell 5%, and the bank dividend was lower than some investors had hoped for. Its share price fell 6%. Last Thursday. Seems like a long time ago, doesn't it? That was the last trading day we've had. It's down 3% so far this year. Now compare that to Westpac and National Australia Bank, which are up around 12%, and Bank of Queensland doesn't look so good.
Sean, broadband network owner Unity Group has entered into a binding $3.6 billion sale deed with a consortium including New Zealand's Morrison & Co. and Canada's Brookfield Asset Management.
Yes, this one's been bubbling along for a little while. The $5 a share offer will now be put to shareholders after the Unity board recommended the bid. Last month, Unity ended talks with another bid, Macquarie Asset Management. Back then, it was concerned that sensitive information could leak to Macquarie Asset, which is actually a competitor. On Thursday, its share price finished up 3%.
All right, now, Sean, I know you love talking about lithium, and we have spoken quite a bit about lithium in the last couple of weeks. And the share price of Alkem, which is the Australian and Argentinian lithium carbonate producer, jumped 6% late last week.
Yes, Alkem said it plans to triple lithium production by 2026. Triple lithium production. Quite incredible. Like other major producers, Alkem's had a great run and its share price is up nearly 130% over the past year. I reckon we're going to keep having these sorts of conversations and chats over the next couple of years when it comes to some of the lithium producers.
Yeah, tripling lithium production by 2026. That's only, 3.5 years away.
I know. Incredible, isn't it?
All right, Sean, new home sales were up by nearly 4% in March.
Yes, the chronic rental shortage and flood of people hoping to buy a house before interest rates rise too much has pushed up sales of new detached homes, according to the Housing Industry Association. South Australia posted the strongest rise over the month, up a massive 24%. Followed by Queensland at 12% and Victoria at 11%. By contrast, sales dropped 10% in New South Wales and 5.5% in Western Australia.
Sean, we have talked a lot about Star Entertainment, and there is just pretty much every day brings another interesting and usually pretty extraordinary update. Star Entertainment has been accused of attempting to mislead the New South Wales gaming regulator, stating that notorious Chinese junket operator Alvin Chow was an astute businessman and of good repute, removing all mentions of his links to triad criminal gangs in a key internal report.
Yes, now according to the Australian newspaper, in a risk assessment dated August last year, Star's senior managers dismissed explosive evidence from the New South Wales Bergen inquiry into bigger rival Crown Resorts about Mr Chow's criminal links as rumour and innuendo, declaring that the company could still do business with him. It comes as Star's Chief Legal and Risk Officer Paula Martin told a Royal Commission-style inquiry that she has varied recollections of important business meetings over the past couple of years, including whether the casino was monitoring suspicious transactions in bank accounts linked to Chinese gamblers. We'll get more of this one this week.
We sure will. Now, how about this one? Big Four consultancy Deloitte is suing one of its own directors for allegedly unlawfully claiming at least $3 million in sham work expenses from the firm and clients to fund his own lavish lifestyle in what they've described as an elaborate and long-running fraudulent scheme.
According to the Financial Review, documents filed with the federal court alleged former restructuring director Paul Quill made thousands of fraudulent expense claims from 2016 to 2022 to buy at least 100 artworks and sculptures, designer furniture, luxury clothes, watches, and, Michael, a hot tub. The case is scheduled for hearing this week, and Mr. Quill hasn't had his say yet.
Sean, just a quick one. Ratings agency Moody's has upgraded Qantas's credit outlook from negative to stable for the first time in 2 years.
Yes, more good news for the airline following last Thursday's surge in its share price. The main benefit is that it should allow Qantas to better access debt if it needs to. But in fact, Moody's expects Qantas to reduce debt next year and show continued expansion in the loyalty and freight arms.
Moving on to overseas news, and China's economy accelerated in the first quarter of the year, even though lockdown kept tens of millions of people confined to their homes.
The world's second largest economy, Michael, grew at a 4.8% clip, faster than the final 3 months of last year. It's a very, very good result, even if some economists have questioned its veracity, because China's zero-tolerance approach to COVID-19 is hitting consumer spending and industrial production. Undoubtedly, a lot of the jump came in January and February, and it petered out somewhat in March when lockdowns really hit Shanghai specifically. Of course, any reduction is bad for demand for Australia's commodities. Overall, Beijing has forecast that the economy will expand by 5.5% this year.
Sean, in Ukraine, the port city of Mariupol has been encircled by Russian forces, but still they don't have full control.
Ukrainian troops in the besieged city seem to be holding out quite incredibly. Attacks across the country, including in the capital Kyiv, have escalated in the last 48 hours or so. Meanwhile, Pope Francis called for peace in an Easter sermon and warned the conflict could lead to nuclear war. And Ukrainian officials will be in Washington this week for meetings of the International Monetary Fund and World Bank. They're seeking financial support.
All right, now up next, Sean, is the Fear and Greed Daily interview, and today you're speaking with Amanda Rose, founder of Small Business Women Australia. Yes,
as I mentioned before, a very, very passionate advocate of women in business, and in this instance, small business, but all around. And she makes the very fair point that if you can actually enable many of these women in small businesses, you will just get a much, much better outcome for the overall economy because you have more people doing it. It's pure logic, and, Amanda's always great to chat to. She's very entertaining.
Yeah, that's a really good chat. That is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. And if you've happened to take off the long weekend and you're just settling back into Fear and Greed, there's a couple of things for you to catch up on. Yesterday's interview is definitely worth going back and having a listen to. Brent Kachuba from financial insights company Spot Gamma in the United States. He talks about really the big US tech stocks, really all household names, and what to look for and what to consider when thinking about investing over there, and also the week ahead with our resident economist, Stephen Koukoulas. And just one little reminder before we go, if you enjoy our old Sunday show, which is now called Safe Word by Fear and Greed, you need to find it in its new home. It lives on its own now as a standalone podcast, so search for Safe Word by Fear and Greed on your podcast platform. Hit subscribe and you'll get the latest episode when it's released this Thursday. Thank you very much, Sean.
Thank you, Michael.
It's Tuesday, the 19th of April, 2022. Make sure you're following this podcast as well and join us online on LinkedIn, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.